Welcome to Moneyman. Let's look at the state of the markets for the month of October 2025. This is a brief about what I do, what I've done till now in life, and how I'm working towards helping busy professionals create wealth. You can read more about this on my website, which is mentioned here. Let's dive in. So this is my quant market map, which is a model which tracks about 20 different metrics across the market. And this indicates or gives me a great idea about how the markets have been, how the markets are behaving. What I presented here is actually a very simplified version, simplified and color-coded version, where one just needs to track how the overall map is looking like. Reds are bad, yellow is no man's land, and green is obviously good. If you look at October and how it started, there were a lot of reds, which was in line with how September usually is. September is usually a very bad month for the markets, and that has been going on since the last September. October began very well with a lot of reds turning into yellows and eventually into greens. However, we can see that the market has not yet broken out of its shackles. It is still restrictive in a lot of ways, and that can be seen with many more reds still present. Towards the end of the month, we saw a slight pullback and a few reds coming back again. We'll look deeper into what actually happened. This is the index, Nifty 500 index stock heat map. Just gives a clear idea about how all the 500 stocks have behaved over the last 1 month. If we see here, we see a lot more greens and actually dark greens as per this particular scale, which shows that stocks have actually advanced very well. I prefer to track Nifty 500 instead of Nifty 50 because 500 actually covers a lot more stocks and gives a broader idea about how the markets have behaved. 50 stocks are too narrow to track, so I prefer not to track that. So this gives an idea about how this particular month has progressed, and it actually looks like a good start. This is the overall kind of almanac for Nifty 500 and tracked over the last 25 years. You would remember last month in my video on state of the markets for September 2025, I had mentioned that we are entering one of the best quarters for the year, which is October, November, December. Now, within this particular quarter, October tends to be average, but with increased positive volatility, while November and December are the months where good money is made. Even within that, we saw that October gave a return of 4.29% on the Nifty 500. That's a pretty good month. If you look at all the months, it is one of the probably the top 5 months in the last 25 years. That's a good start, I would say. And now we are entering into the good part of this quarter, which is November and December. Now, November has a very unique thing. In the entire year, November is a month where, while it is overall positive, it shows a dip in between the 10th to the 20th of the month. We see actually 2 dips happening, and let's see how it plays out. But overall, it is expected to behave pretty well. And I believe that we've had a good start in terms of indices at least going up very well in this particular quarter. And this is how we have seen the indices return to us. Nifty has given a good 4.5%, which is a good news after a long time. And mid caps have really done very well, just under about 6%. If we see the YTD returns for 2025, it's only the small caps that are still lagging. And that is why we are seeing that portfolios are not going up. Because primarily a lot of portfolios comprise of small caps and mid caps. The broader indices have actually returned pretty decently for the year, and most of it has come only in the last month. So that's a good news to see. Look at the index breadth. This actually will tell us why a lot of portfolios are not performing, because all the action seems to be in the large caps only. Small and mid caps are yet to start their proper rally in spite of mid caps having returned well, but it's only the large caps that are really doing well in this market. and we are seeing a lot of buying happening over there. We will see individual retailers' portfolios start performing well once the small cap indices start their move, because individual retailers are exposed heavily to small caps and moderately to mid caps. Look at the strength in the indices. After a long time, we are seeing RSI, which is basically a metric, a technical metric to track the strength, the magnitude and the force of price movements in the indices. After a long time, we are seeing that these, on a weekly basis, on a daily basis and a weekly basis, are actually trending above this midline, which indicates levels of 55, as I mentioned here. Usually when this goes above 55, we see a lot more movement, a lot of momentum building in the market, a lot of strength building in the market. And the month of October has taken us above this. Now it needs to be seen if there is a follow through in the coming months or not in this aspect. So for now, it is looking good. Now look at the overall markets. Overall market breadth is yet to catch. While in the last slide we saw that large caps have started performing, the overall markets are yet to start catching up. I always say that indices is not equal to markets, and this is exactly what proves that. While indices have done very well, especially the mainline indices, the overall markets are yet to do that. This middle line, the dotted line, which indicates a 50% value, is extremely important. Only when the market breadth for all these three metrics crosses 50% do we actually see good momentum building in the market. Usually that is what leads to strong bull market conditions, and we are not seeing that yet. We are actually in a phase which is no man's land. I normally call between 40 to 50% as no man's land, because there are hardly any movements happening. In this phase, up moves happen, breakouts happen, but they fail usually. Once the market breadth crosses this dotted line, that is above 50% levels, we will see a lot more positivity building in. But the movement has actually been very good. If we compare how these metrics were as of 30th of September and how they have reached, where they have reached as of 31st of October, you'll see that there is a lot of movement. It was actually a lot. The markets were in dire straits as of September end. Look at this. These three metrics were really, really low, and they've actually climbed up a lot. Stocks above the 30-week moving average has been more or less constant. And one of the most important metrics in this is the number of stocks above both the 4-week and the 10-week moving averages. It was just 24 as of end of September. It has come to 41. This is a great thing, because when more number of stocks cross this particular line, this cross both the moving averages, it means that the market is gathering a lot of momentum and we are reaching somewhere there. This is the returns distribution for the last 1 month. What we are seeing is a lot of movement has happened towards the right side. Now this is very crucial, because this means that a lot more stocks are participating in giving positive returns. Having said that, we still don't have enough, because we still see a big chunk of stocks which are between 0 to 10%. That is a combined, these two bars combined. So as I said, the markets haven't broken out of their shackles, but there are a lot of positive movements that have happened, and this is good to see for now. This is playing as per the seasonality that I had mentioned in the last month's video. Look at the net new highs that the markets have made over the entire month of October. This is much better, because September we saw a lot of net new lows happening both on the daily frame and the weekly time frame. And now we are seeing a lot of net new highs being made and sustained. If you look at the net new highs made over a weekly time frame, this indicates how the overall markets are looking like, which is very positive. On a daily time frame, in the last few days, we've seen some ticks down, it's been trending down. These are pullbacks, and that is exactly what we've seen in the market. But it is still in positive territory. It is still good. Let's see how November starts. But this overall indicates that it's not a bad market condition. Whatever happened in the last few days was just a brief pullback. And this also sets a market, it sets it up for further up moves in the coming times. So there is a lot of underlying strength in the market. It can go up very well in the coming days and weeks. The velocity index, which basically tracks advances and declines, actually shows this. What I do here is track a different version, which is a returns weighted, cumulative and rolling value over the last 3 months. So comparably, when we see in September, towards the end, we saw a dip happening in September, but the markets revived out of that, and actually the values have been going up. This is of course on a cumulative basis. While the values don't really matter here, it is the direction and the trend, the angle at which it is going, which matters the most. And we are seeing a healthy uptrend right now. This is good to see right now. Look at how stocks have behaved as per their moving averages. Somewhere around September end, we saw the green area, which is the most important area, stocks above both the 4-week and the 10-week moving average. It reduced towards the end of September, but it has gone up pretty well over the entire of October. What we have to now watch out for are stocks which are on a downtrend, which is the red area, which is below both the 4-week and the 10-week moving average. Now, ideally, how would I want this to play out in the coming month is for a lot more stocks to start trending above their 4-week and 10-week moving average. Usually they start with the 4-week moving average and then they go up the 10-week also. This is extremely important from a tactical point of view. So I'm looking at this green area increasing and the red area shortening. That is how I would ideally like to see this market play out, and that would further mean that there is a lot more strength building in the market and momentum also coming in. Look at how market health has progressed in the last 3 months compared to values for July 31st, August, September, and now October 31st. This indicates what percentage of stocks are how far away from their 52-week highs. We've actually seen a good uptick in the stocks which are just 10% below their 52-week highs. 52-week high is an extremely good metric to track because it shows how strongly stocks are behaving in the market. So now, after trending for about between 16 to 13% over the last 3 months, the number of stocks near their 52-week highs has actually gone up to 19%. And if we look at the stocks within on an overall 20% of 52-week highs, that is a combination of these two metrics, it's a good 38% now. That is a good beginning. And that is why I'm saying that we are seeing a good beginning in the market where things have started moving up. How will this basically play out? How would I like for this to play out if the markets were to sustain and the participation to increase? Would be more and more stocks entering the green and the blue segments, which is within 10% of their 52-week highs and within 10 to 20% of their 52-week highs. This will indicate that there is a good market health building up, and that sets us up for good money making in the coming months. This is how sectors and industries have performed in the last 1 month, and this gives us a peek into which are the strong segments in the entire market. Now it is clear that the overall market is not going up, as seen from portfolios, as seen from all the metrics that we've shared here. This shows which pockets of the market are actually behaving very, very well, and the ones that could be potential leaders. The one that is standing out in all sectors is clearly banks, and PSU banks are leading them backed by a lot of regulatory good news. But it is clear that those are the ones that are leading the markets right now. And the top 3-4 are the ones that are doing very well right now. In terms of industries, these are the ones that are showing good upticks. I've just taken the top 20 names, and one could look at the top 5 or 7, which are looking very, very well. Now the other metrics, like percentage of stocks within their near to their 52-week high, that actually shows where the underlying strength is, and one can try and identify stocks from those particular sectors and industries. So this just gives a complete combination of which are the good ones. Look for the ones where all the values are ticking towards the topmost side. Let's come to how factors are performed, and this will give us a good idea about what is happening under the hood of the market. Now, factors essentially show the different investing styles that are prevalent in the market, which is value investing, quality, momentum investing, and low volatility. And of course, I've also added a market comparison, which is the NSE 500, Nifty 500. What we are seeing, and we have been seeing since the past many months, is that it's the value stocks that are getting bought into, and that is why you see the value strategy, that is a value factor, performing the best. The others are not performing so well. Now, this means that a lot of buying that is coming in, a lot of volumes that are coming into beaten down names which are available at great prices, where value buyers are seeing value and then they are accumulating them. That is where institutions are focusing right now, and it is clearly being seen from how these factors have done. The reason why markets are not interesting right now is also seen from here. There is no momentum in the markets. Momentum is grossly underperforming the overall market. In fact, it is negative for the overall year. That is on a YTD basis from January. There is no momentum. There is no excitement. Excitement is where momentum comes. There is no momentum right now in the markets. However, we are seeing this ticking up. Let's see how it takes us over the next couple of months, because these are November and December are usually good momentum months for the markets. So let's see how that happens. But right now we are seeing value buying happening. This is also the reason why a lot of portfolios are still beaten down. A lot of stocks are still way below their 52-week highs, because value buying happens when they are way, way, way below 52-week highs. In fact, value buying happens when they are near their 52-week lows and near their 200-day moving average or 150-day moving average, which is indicated by the 30-week moving average in my presentation. So this gives us a good idea about where the real buying is happening, and where the real money is flowing and where the volumes are coming in. So this is an interesting slide that I thought I should show. This compares emerging markets versus developed markets. For developed markets, I've taken a proxy as the S&P 500. For emerging markets, I've taken it as MSCI Emerging Markets Index ex-China. It's extremely important because ex-China means that the biggest volume goes out, and the next best one is India. Now, interesting to note that India as an emerging market amongst emerging markets, seen over a 10-year period, has grossly outperformed all the emerging markets, but seen over the last 12-month period has grossly underperformed. We all know that Indian markets have been trending down, but if we look at an overall emerging markets perspective, what we have seen as an overall underperformance vis-a-vis US markets actually stalled somewhere here and is setting up to outperform the US markets. This is a zone. This is of course a ratio chart. So this is a zone that I'm seeing, that I'm keenly watching for. Once this ratio chart crosses this zone and crosses above this particular green line, we will start seeing the emerging markets outperforming the developed markets, especially the US markets. Now this can happen through two ways. One is that emerging markets just don't perform, go sideways, but the US market start crashing down, which is one of the expectations of mine that US markets should be topping out sometime soon. The other bit is where the emerging markets also start moving up. Why are we talking about all of this? It is to track where FII money is going. And this is one of the reasons why I'm expecting FIIs to become net buyers in the Indian markets going forward. I think it's just a matter of time. That is, of course, my view. But I feel that once there is no juice left in the US markets, money will start flowing out into other markets. And that is one of the reasons why I'm also tracking emerging markets ex-China. So that puts us, which is India, in a very Indian markets, in a very unique position to attract all these flows. Of course, fingers crossed. There's nothing set for certain, but charts are indicating that that time is coming soon to us. Talking about FIs, look at how they are positioned. And this is an extremely important chart. You would remember this analysis from my last month's video, where I've been saying that FIs have been holding record net short index positions since August of 2025, which is this particular range which I have indicated. Usually when this particular value goes below the negative 3.5 lakh figure, markets rebound. But this was the first time that they did not. And this also is probably the longest time period that FIIs have held these record net short index positions, which is from August 2025 till around beginning of October 2025. That's a significant amount of time. And that was also not allowing our markets to go up. This is the Nifty 50. And see what happened once a short covering happened. Okay. Talking about short covering, we were all expecting short covering to happen, but it just did not happen. And from these levels, short covering is rampant. It just takes the market up, like markets start shooting up. That is how it has happened in the past. This time it did not happen. But once short covering started happening, see the positions being reduced continuously and markets also started trending up. That is why we are seeing a lot of movement in the top stocks in the market in the Nifty 50, because that is where the maximum short index positions were held, and now we are seeing them to be liquidated. Of course, in the last few days we saw a sudden increase in the net index positions. Let's see how that plays out in the coming months. We also saw the markets pulling back, but we will see how this happens. But one good point is that the record net negative positions held are actually no more being held. The values increase. So this is good to notice. This tracks how DIIs and FIs have been buying and selling in the market. You can see that from, of course, DIIs have been always buying, so that's a good thing. People say that they are holding up the market, but they are not. What you have to see is that DII buying from September has actually been trending down compared to the earlier months. The second most important bit to notice is that DIIs, which are essentially mutual funds, meaning a majority of DII money is mutual fund money, and because they're flush with funds, they are buyers. They're smart buyers. They don't just buy. They don't buy at market levels. They wait for their prices to come and they buy choice stocks. And like I told you some time back, they have been essentially value buyers in this entire market. They're not just blind buyers. If you look at the FI numbers, it has been trending negative in a big way since July. We saw one good uptick of huge positive FII cash buying, and after that again it has started going negative. Let's see how this plays out, but I've already spoken about what I feel in terms of FII buying. This is of course our disclaimer. So this brings us to the end of this. So what are we looking at? We are looking at October, November, December being a great quarter for the markets, which have begun well. As I say, well begun is half of well done, right? Or whatever they say about that. But we've begun the quarter well. October is usually not the best month in this quarter. November and December are the best months, and we are seeing that seasonality hit us. So hopefully November and December will perform really well for the markets. We are seeing emerging markets starting to trend up and getting positioned to perform really well vis-a-vis developed markets, that is US markets. We are seeing US markets in a hugely oversold, in a hugely overbought zone, which is overheated zone essentially. I am personally expecting US markets to start trending down, and that should happen anytime now, I feel. With that happening, we could probably see the inflow of FII money, and once FIIs start pouring in money, DIIs are anyways, they've been buying since a long time. But once that money also comes in, I think the sentiments will be lifted. The trade tariff deal has been pending for a long time. The timelines for that getting announced are coming anywhere. I mean, they're somewhere near only. I believe that sometime in November is when they will be announcing it. So a lot of factors are coming together to support the seasonality of November and December being great months for the markets. Of course, nothing is certain in the markets. We can just keep our fingers crossed. But let's begin with that. I hope this was of value to you. Stay tuned for more. Thank you very much for your time.